What is Bitcoin mining? Users of traditional government currencies, such as the US dollar or the euro, must have faith in a central authority to oversee and control the movement of money and to punish those who do so. In contrast, the management of money in Bitcoin is done by software in a network of users. The system is decentralized, or free from any one party's control, because users retain data that, with government funds, would be held in a centralized server or system of databases, such as in the transaction records of central banks. But how does this actually function? Bitcoin utilizes a procedure known as mining to maintain the security of its distributed network and control the amount of new money that is issued into its economy. Bitcoin's inventor Satoshi Nakamoto used specialized machinery to mine the first bitcoins in 2009, turning electricity into the digital currency. Today, there are a lot more miners operating and maintaining enormous data centers all over the world only to support the network. How does Bitcoin mining work? One of the essential components of Bitcoin's ability to control the distributed computer network that makes its software viable is mining. Miners create the blocks that make up the Bitcoin blockchain and contain the history of network transactions by competing to solve cryptographic problems. When a miner finds a block, they broadcast it to the network so that other nodes can confirm and approve it. The successful miners receive fresh Bitcoins in return for this service. Proof of work, POW. Proof of work, POW. The mechanism that keeps this operation on schedule requires miners to use computer resources to add blocks to the blockchain. While many will take this as a criticism against Bitcoin, it is crucial to remember that many financial-related operations, such as gold mining and cash generation, consume far more energy than Bitcoin mining. Miners must locate the correct hash, or string of pseudorandom integers, that satisfies the protocol's requirements in order to solve the cryptographic problems and discover legitimate blocks. In essence, it is a lottery system where the likelihood of additional blocks being discovered by miners rises with energy expenditure. Any arbitrary amount of data can be input into the mathematical action of hashing, which results in a fixed size output. In the Bitcoin protocol, computers compete to create hashes until one of them has a tiny enough value to be used as a block proposal. Other computers can then check to see if the solution is correct by receiving the winning hash. The user who aired the block is given fresh Bitcoin if it is legitimate. Mining difficulty. However, as more miners join the network, the competition for locating blocks becomes more intense. The cost of manufacturing rises along with the level of difficulty, and thus the price of the underlying good, in this example, Bitcoin, rises as well. Technically speaking, the likelihood of discovering a hash is roughly inversely proportional to a miner's overall network mining power. This indicates that a miner's chances of finding the hash and earning the block reward increase with the amount of processing power he or she is able to contribute. Miners occasionally combine their efforts because those with a tiny share of the mining power are unlikely to find the next block and will therefore rarely be rewarded. Today, the majority of mining is carried out by mining pools, which are networks of cryptocurrency miners that pool their processing power and divide the block reward among themselves. Bitcoin's monetary policy. Although this mechanism helps Bitcoin miners, it actually performs a significantly more important job by enforcing Bitcoin's monetary rules. In addition to helping to activate and enforce restrictions concerning the Bitcoin money supply set forth by the software itself, miners control the rate at which new Bitcoins are made accessible to consumers. For instance, to keep the total supply limited, the amount of Bitcoin, BTC, distributed in each block is reduced by half when 210,000 blocks are generated. The halving event guarantees that the scarcity of Bitcoins will increase over time. In actuality, there will only ever be 21 million BTC brought to the network's economy, per the software rules. In order for Bitcoin to gradually increase in value over time and serve as a hedge against fiat currency, Satoshi gave great weight to the fact that it has a fixed quantity. By 2020, users would have access to more than 18.5 million BTC. It is anticipated that the final block will be mined in the year 2140. Developers continue to have a high level of confidence in the protocol because of the inflationary rate that is built into the system and Bitcoin's consequent focus on long-term stability and openness. Additionally, the fixed monetary policy is to blame for the rising trend in investor numbers.